if you've figured out anything about this book, the problems are usually harder than what you see on the test. So if you find yourself frustrated with something, know that there will be a practice test tomorrow that's more true to the test. If you can do this hard stuff, the test material should be okay. So in problem A, feels good, you guys? We're just cruising along here. Soon we'll be done with all of our chapter stuff, which is exciting. In problem A, it's on page 599. They are asking to take two sole proprietorships, so the Sorensen and Lucas companies exclusively, are looking to form a partnership. You see Sorensen and Lucas, their incoming balances of accounts for their sole proprietorships. All cash will be transferred to the partnership, and the partnership will assume all liabilities of the two proprietorships. Further, it is agreed that Sorensen will invest an additional $5,000 and Lucas will invest an additional $19,000. And it's asking you to prepare separate journal entries to record the transfer of the proprietorship assets to the liabilities of the partnership, and then a second journal entry to journalize the cash investment for each partner. Now, what you need to do is think about some things. If you look up at Sorensen specifically, cash is cash. That $14,000 cash will definitely go right over to the partnership. But AR and its contra assets, inventory, equipment, and its contra asset, all of those, they sit down as they form the partnership and go, well, you owe $17,500, or excuse me, that's AR owed to you with $3,000 as allowance for doubtful. But look at down below what they actually decided on. They decided that the AR will remain $17,500, but the allowance for doubtful, they're actually bumping it up to $45,000. So do you see that? And inventory was valued at $26,500 up top, but as they probably met with the lawyers and formed their partnership, they bumped inventory value up to $28,000. Let's talk about equipment for a minute. Equipment is valued at $45,000 with accumulated depreciation at $24,000. Do we bring accumulated depreciation to a partnership? No, rather we just place a new value on it, and you see that that's what got decided. Now don't forget, for the first time we're seeing some liabilities that are coming with the business, so notes payable, accounts payable, we'll work through those. So do you see where we're getting the numbers? The top is what the balances were coming in. The bottom little section is what they agreed upon. Okay, so let's do the first partner. Here's what his now partnership breakdown is going to be. He brought cash of $14,000. What value are we going to put in for AR? Remember, I got done telling you that it was $17,500. Well, it looks like they agreed that $17,500 is the balance. Okay, so the business cash is going to go up by $14,000. The business AR is going to go up by $17,500. What got decided a little differently, though? Oh, they're listing all the credits later. Sorry. Notice this number is a little bit different, but they're listing the credits last, so that's okay. What's our next asset that he's bringing to the table? Inventory. Did they decide a different dollar amount on that? $28,000. Although he brought originally $26,300 or $26,500, they collectively as a partnership decided to bring the value of that up. And then equipment, remember, it had a balance and a contra asset that went with it, but depreciation does not transfer over to a partnership. We did have that contra asset of allowance for doubtful. You might want to write contra asset there. Did he bring some liabilities to the partnership? And according to the little problem bio, we're going to take both of their full amounts. They're not in that bottom portion, they're up in that top portion, similar to how cash was. So then Sorensen's capital per the partnership is $40,000. And that is just a bunch of forced math to get to that number. We don't necessarily, we're not concerned with what his capital was for his sole proprietorship. This is his partnership capital. I would like you to try the next partner right now on your own. And he brought $12,000 to the table. I want you to quickly try to formulate the Lucas company, noticing that he brought 12 grand. There was some assets that he brought in, but yet they decided differently on some balances. He too had some liabilities that he brought. I think what we're seeing different in this problem that we didn't in the brief exercises, we didn't ever bring over liabilities, I don't think. But they're pretty straightforward, and it just blatantly said they're bringing over the liabilities for the two proprietorships. The answers are there. Lucas has a slightly lower balance. They did make two additional investments. Further, it is agreed that Sorensen will invest an additional $5,000 cash, and Lucas will invest an additional $19,000 cash. So they end up being just another couple of entries. The business cash goes up, and so does the value of the capitals. So each partner is contributing a little bit more of personal cash to the business. The book does ask for us to do, what does this look like on the balance sheet? I am certain we don't have enough points on the test to do that kind of stuff, so I'm not going to have you do that third part of this problem. It just is basically taking all those assets that are coming in, listing them there, whatever liabilities are left, and then each of the owner's capital accounts. So we're not going to do that portion. One more time, if you missed something, it's all there. And that's the first problem. So you will do the B version of that tonight as homework. This next one, here's all my notes if you can see where we're going with this. The next problem is, hopefully I make it sound really easy. It's just that they want us to analyze sharing net income 3 different ways. I usually don't like problems like this because I like it to like sequentially make sense, like what we do in one goes to the next, but let's just look ahead. We're still on page 599. At the end of the first year of operations, the NBS company's accounts show the following. So in the first type of, well, let's backtrack. The 3 big activities that we did in this chapter, we formed a partnership, we shared net income, and then we liquidated a partnership. So those are the 3 problems we're going to do. Right now, we're saying, okay, at the end of the year, here's where things stand, and we have some net income. What you see are 3 separate scenarios. So do you see where it says instructions? Journalize the entry to record the division of net income using the following independent assumptions. So version 1, version 2, version 3. They don't relate to each other, they're just saying here's one scenario, here's a second scenario, here's a third scenario. Okay, so just so you know, these are not related. Okay, I want to see your workbook page so I can see what we're doing. Okay, so they make it pretty obvious, scenario 1, scenario 2, scenario 3, and they give you room for calculations. Perfect. Okay, so in the first scenario, we've got net income of $30,000. How would they have arrived at that net income? Would they have done some closing entries and they would have closed what into what? And then another what into what? Do you remember in the notes, I had all the closing entries there? They would have closed sales into income summary. They would have closed expenses into income summary and hopefully arrived at a surplus or a net income. And in this scenario, we're looking at a $30,000 net income. So you'll see income summary be 30 grand. Income summary allowed us to close sales, which must have exceeded expenses. Okay, they didn't ask us to do a little T account, but they're just giving you the number. Net income was $30,000. I could see the problem on the test, or excuse me, I could see the issue that some of you would run into the test. You'd write net income there. Just remember, net income is driven from the account called income summary as you close sales and as you close revenue, or expenses, excuse me. The income ratio is 6:3 to 1. So let's do this quick. A 6:3 to 1, 6 plus 3 plus 1 is 10. So one partner has a 6/10 or 60% share. One partner has a 3/10 or 30% share. And then of course the last partner is 1/10 of the company. So do you see how you get these numbers, hopefully? So if we list our 3 partners, we have Art Nienstedt, Greg Bolin, and Krista Saylor. Okay. Each of their capital gets credited if we're looking at net income. And I'd be okay with Nienstedt, Bolin capital, or Saylor, comma capital for each of them. The $30,000 was of course the net income. We knew the 6:3:1 ratio was 60%, 30%, and 10%. So in this independent scenario, this is how they shared the net income. Nienstedt, of course, gets more than a majority here, more than even 50%, gets 60%. And it's good when times are good. Who would see the biggest hit if this was a net loss? Nienstedt, that partner. Okay. So that's independent scenario number 1. Okay. What we're about to do has nothing to do with what we did in independent scenario number 1. Now we're going to move on to independent scenario number 2. Net income was $40,000, But what's happening in scenario number 2? Why is net income getting chopped up a little bit? The salaries, here's the weird part. Are all of the partners getting salaries? No. Nienstedt and Bolin are given salaries of 15 and 10 respectively. I don't know about the other, Krista Saylor. I don't know why she's not getting any money, but whatever's left, they're going to share equally this time. Okay, you are going to see the journal entries. Please don't put those in. Let's go down to your calculation section. That's what this is. Okay, I know you can see the journal entries. Please don't focus on those. They're saying net income was $40,000. So put that in under the calculation section. Again, we're not doing this part right now. I know you can still see it, but I don't want you to focus there. Net income was 40 grand. Unlike independent scenario number 1, they're not sharing that with the 6:3:1 ratio split. They're actually sharing whatever is left after we chop up that net income. In other words, pay salaries, then they'll share it equally this time. 2 of our partners get a salary allowance. 2 of our partners get a salary allowance. Nienstedt and Bolin. We have a remainder of $15,000 that will get shared equally among the 3 partners. And you might say, well, what about this Saylor person? Krista Saylor, she didn't get an allowance, but just remember, we don't know what was decided at that first roundtable discussion with their lawyer as they formed their partnership. We don't know why she's out of the picture. We're not going to question that. We're just the accountant. Okay. So out of that $40,000, there's only 15 that we are going to share. Well, 15 divided by 3 partners equally is obviously 5 grand. So in independent scenario number 2, our income summary or our net income still is 40 grand. We have 3 partners that are going to get $5,000 of their remaining net income, but the other 2 partners had a salary allowance. Notice how those 2 look. Nienstedt got paid 15 grand. Bolin got a salary allowance of 10 grand. And then we calculated that each partner gets $15,000 divided equally to land at the 5. So I just wanted you to see that it was 15, the salary allowance plus whatever was remaining. So our poor Saylor had $0 for salary, but she still got 5,000 of that equal split. So what's going on here? These are the salary allowances. This is the equal split of net income. In your notes, I'd maybe write what I just showed there, just because when you're trying to do this on your own, you might wonder where those numbers came from. So the salary allowance, and then whatever was left was an equal split. Would it had to have been an equal split? Could it still have been the 6-3-1? It could have. It absolutely could have. Yes. Yes. And it's just how it's initially set up. Can you see where partners get mad? Yeah, so you got to set that up. That's why you want to involve a lawyer when you're forming a partnership. Okay, so that was independent scenario number 2. So we've done number 1, we've done number 2. In the independent scenario number 3, things get really complicated. Net income is only $19,000. Each partner is allowed an interest of 10% on their beginning capital balances, plus Nienstead is getting paid. Do you think we're going to have money left? Just with a small net income of $19,000, each partner is getting 10% of whatever their capital balances were at the beginning, plus we've got a partner getting paid. The writing's on the wall here, people. We're going to be left with a deficiency. So again, we're going to just forego the journal entry for a minute, and we're going to run our calculations. Net income this time is $19,000. I assume the workbook makes this easy for you, doesn't it? Good. We have two things chopping up that net income. First, each partner is given 10% of whatever they bring in for their capital balance. Second, we've got one partner getting paid. This time we have a 10% interest allowance. It's kind of like an incentive to keep your capital balance in healthy standing. And there's our three partners. Where am I getting the 48, the 30, and the 25? Their beginning capital balances up top. So 10% of 48,000 is of course 4,800, 3,000, and 2,500. So out of the 19, we only have $8,700 remaining, because 19 minus 48 minus 3 minus 25 equals 8,700. Again, the writing's on the wall here. We did not bring in enough net income because this Nienstead character is getting paid $15,000 on top of whatever. You know what? Maybe he works and the other two are off on their private jets going to their private islands. Who knows? We don't know. We also have to stop and say salary allowance for Nienstead of 15. So 8,700 minus 15,000, we are looking at a deficiency of $6,300. We are going to happily share that $6,300 evenly. Is it money in or is it a hit? It's a hit. So again, this is a share equally. What does the journal entry look like on this rather complicated one? We still have net income of 19 grand. So even though the owners are experiencing a slight hit, we still have income, still net income. We've got our three owners. Let's start with Nienstead. 4,800 is 10% of his capital, plus 1,500 or 15,000 is a salary allowance, minus his shared hit of 63. I probably need to go back and just say it's this 63. Oh, I should have just moved it down further. 63 times a third, so each of the three partners, they're going to experience a minus $2,100 hit to their capital. They're each still making money at least. It's just not very much because Nienstead gets $15,000 for a salary. So he had his 10% of his capital, his salary allowance, minus the deficiency. Still making $17,700 in his capital account. The other two partners are not nearly as lucky. Bolin had a $3,000 10% interest on his capital, minus the hit. His capital only is at $900, and that last one is only $400. So the numbers are coming from, I'm going to circle in green, That's the 10% of their capital balance coming in. We see salary allowance. And this is a deficiency because we paid our owners too much. There wasn't enough left for sharing net income equally. We're sharing net income, but we paid ourselves too much. We got a little bit greedy. There's a next part to this problem. Go to the next page, page 600. Prepare a schedule showing the division of net income under the third scenario. I'm glad they're having us do a schedule. I like the schedules. You see all of this more. I wish they would have had to do this first, but prepare a schedule. So we had scenario 1, scenario 2, scenario 3. Scenario 3 was obviously the most involved, and they're asking us to prepare a schedule. You have a nice one in your book, I hope? Yes. Perfect. Well, just like anything, let's put the net income as king at the top because we're going to try to get back to that number by the time we're done doing our schedule. So that was a $19,000 net income. We have our 3 partners. They seem to be sharing things equally, so it's not like we have the 6 to 3 to 1 split. In that third assumption, we were sharing everything equally. You know, so I could just say 1/3, 1/3, 1/3. Okay. Let's start with. It always begins at the. It always begins with salary allowance. So only one partner in that third scenario was receiving a salary allowance. So mean stats 15 plus each of the other two's 0 equals 15. We do not have much net income left, do we? We only got $4 grand. The next one you show on a schedule, you always begin with a salary balance or allowance if there is one. Then you get into the interest allowance on capital. In this scenario, they said 10% for each partner. So if you recall where we got those numbers, it's the 48, it's the 3,000, and the 2,500. So these were the beginning capital balances. And they're just how they originally formed their partnership is they were going to get 10% of whatever was sitting there in their balances. So 48 plus 3 plus 25 equals 10,300. Our problem is this. If we look vertically now, 15 plus 10,300 is well above our 19,000 net income. So we've overpaid our people. This is a breakdown of each of our partners. We just got done journalizing all of this, but this is where you would journalize what they get to keep in capital. We had a deficiency, and we already calculated this once. But if we took our $19,000 of net income minus this 25,300 and what we've already paid, that's where you arrive at the deficiency of 6,300. And we're going to share that hit equally. So you see each of the partners losing some money. And that's another way of looking at our breakdown. Arriving back at that 19,000. Kind of the cool way to double check if you did it correctly. So it's exactly what we did in that third independent scenario, and we've already done the journalizing. It's just that they had us do a schedule last, which I'm a little bit surprised that they waited that long. That's okay. There is a part C. They want you to prepare the owner's capital statement. We're not doing the financial statements in this chapter, so that would be avoided. I hear little voices. Remember, this is harder than what you're going to see on the test. This is more complicated. They're throwing curveballs at you with one partner getting paid and the other one not. Hold out for the practice test tomorrow. I think you're going to get a lot of relief. Grudge through the tough stuff today and tonight. Practice test will be that shining light that you can do this. So since we got this one done, you'd have this full one for homework tonight. And with 20 minutes to spare, I think if I push through, we can liquidate a partnership here. We are on page 600, 12.3. The partners in Crawford Company decide to liquidate the firm when the balance sheet shows the following. So this has nothing to do with individual people. This is the partnership balance sheet. The partners share income and loss of 5-3-2 split. So 5 out of 10, 3 out of 10, 2 out of 10, so 50, 30, and 20%. The process of the liquidation, the following transactions were completed in the following sequence. Typically, there are 4 journal entries when we liquidate. You'll notice there's a 5th, and I'll talk about why. I don't know if you have an area for notes, but I would like to kind of tell the story here as we move through this. Good. Let's first talk about the 4 steps to liquidate. Let's see, here we go. You guys remember the 4 steps, what we do first, second, third, fourth? What do we sell? We sell our non-cash assets. And then what do we do? Give to the partners or allocate the gain or loss on, what is the fancy word for that? Just remember this one from yesterday. It starts with R. Realization. What's the 4th step? Then what do we pay? We pay our debt or any liabilities. And then we split any money remaining. Split money to partners. There is a 5th one in there, and we'll get to that in a minute. So those are the 4 biggies. We have cash. We've got 3 partners. Jameson, Moyer, and Roper. Their split was 5-3-2. So 5 plus 3 plus 2 is 10. So this guy's 5 out of 10 or 50%. This person is 30%. This person's 20%. I erased. Hopefully you have some space. If we take a look at our non-cash assets, we never would make its own account like what I'm doing for this, and they are broken down. But let's figure out that first. What was our balance of cash coming in? Thank you, 27.5. okay? We're going to sell our non-cash assets. Let's first look at the value of them. We've got a $25,000, I think that was AR if I remember right. Yes. We have a $34,500. That was inventory, and we have $21,000 in equipment. Now we have two contra assets going on here that are offsetting the value of those. We have allowance for doubtful at $1,000, and our accumulated depreciation is sitting at $5,500. Let's stop and say, I thought we didn't include accumulated depreciation. That's when you're forming the partnership. When you're liquidating, yeah, you've been accumulating a pile. Okay, so if I did all the math here, the three assets minus their contra assets, we'd be sitting at $74,000 in non-cash assets. Okay. What'd we sell them for? 51. Did we make money or lose money? We did, because they're valued at 74. We sold them for 51. We had a $23,000 loss on selling our cash assets. Okay. We still are going to see plus 51,000 here under cash because we got 51,000 in our pocket. It's just that we experienced a loss. Yikes. I should have done this before. My apologies. Let's put in the balances for the partnerships. How much is Jameson sitting there with before we liquidated? 33, thank you. How about Moyer? 21. And Roper? $3,000. Okay. But we're experiencing a $23,000 loss. As we figure out taking that hit, are they going to share that hit equally, or is there a ratio division here? It's a ratio division. Jameson's going to take 50% of that hit. So 23,000 times 50% is what, 11,500? Okay, so I see a debit of 51, but oh, I should stop and we should do one journal entry. I'm getting a little ahead of myself, sorry. Jeepers. We basically just did all of that math from the T account version. So, sorry, I got a little ahead of myself here. 51,000 is what we made on that sale. Cash in, woo! We wiped out all of our assets as a result. So there were two contra assets that normally had credit balances. We wiped them out by debiting them. We'll get back to the loss in a minute. Put it in, and I'll explain why. And then we had three assets that, of course, had debit balances that we credited because they are gone. Like we're closing them, we're getting rid of them. We figured out though that we lost $23,000. So you remember from yesterday, a gain is a credit, a loss is a debit, because it's kind of like an expense's cousin. It wasn't money coming in. Okay, so you might want to just write, had it been a gain, that would have been a credit. It was a loss though, so that's seen more as a expense, kind of a hit of the business. I got a little ahead of myself. That was number one. Number two is, okay, all these partners now are sitting here with balances, but they have to share that loss. Not equally, 50, 30, 20. Okay, so Jameson had 11,500 because 23,000 times 5/10 or 50% is 11,500. The other partner is 6,900 of a loss, because that's 30% of the loss, and the last one is 46. Let's just stop for a minute and tell me what partner's in trouble right now. Jameson had $33,000. He can handle the hit. It stings, but he can handle it. Moyer had $21,000. Again, a stinging hit. What's Roper's problem? He doesn't have enough money. We'll get to him in a minute. Let's journalize what we just did. We have debits because this was a hit, because of the loss on realization, because what's going to happen, this is one of those wham bams. We recognize the loss and then we wipe it out right away. Wham bam, it's wiped out. I want to get rid of it. And the partners absorb the hit. Again, this is harder than what we've done in the exercises, and your test will be easier. So just push through on this. Try it tonight by yourself, and then we'll work through the easier stuff tomorrow. What's our third thing on our list? Go back to your little list that you made. Pay the bills, pay the debt. Okay. Well, instead of even listing all of that, we didn't have T accounts for it anyway. Notes payable, accounts payable, salaries and wages payable, all those payables had credit balances. So by debiting them, we're wiping them out, and we used cash to pay them off. Typically at this point, number 4 would be, okay, whatever's left in the balances, let's pay our partners, and away they go. But we have a partner in trouble, don't we? We have the one partner that didn't have enough capital to support that loss on the realization. And so the book adds in number 4 as P. Roper actually paid his deficiency. Yay, P. Roper. Okay, because if I go back to that T account, these two are sitting okay. We just see that P. Roper actually has a deficiency of $1,600. He didn't have enough to cover the loss on that sale of the non-cash assets. But what they're saying here is, hey, P. Roper, woohoo, paid his bill, basically. He paid up, and so he had a hit with a balance and paid it. So if a partner pays, you're going to see cash go up, and he settled up his bill and kind of wiped his account clean. That's complicated. We sped through that yesterday. Typically, it's just 1, 2, 3, 4 as we liquidate, but we had one partner in trouble. So now the rest of the partners we basically pay them out, pay them off. We wipe out their accounts and give them cash. So with Jameson sitting here at 33 minus his deficiency, he's got a 21,500 balance. We know that Roper, he's off the grid already. He's already vacationing. He's already retired. Moyer has a balance of 14,100, and we want to wipe those out. They have credit balances, so we're going to debit them, and we're going to pay cash and shake hands and walk off into the sunset. Okay, so to journalize that, we simply wipe each of their capital accounts out, use our business cash, what's there to pay them, and the partnership is a done deal. You guys are rock stars because we finished everything I'd wanted to. Again, forming a partnership sharing the net income, liquidating a partnership. Those were the 3 big activities from the chapter. We got through problem A. I'm very proud of you. Do all of the problem B stuff tonight. If I come back here, here's a look at your homework again. This recording will be online, so if you are fuzzy on something, you're welcome to tune in and rewatch and re-listen. Tomorrow is a 2-hour late. If you are needing my lab to be used, you're welcome to pop in here for anything. I'll be at some different meetings and stuff. Tomorrow's walk or bike to school day. Jump on that pedal bike. Come on in, some of you that wouldn't work. We will have a shortened class period. We'll get through the B set and I'll give you your practice test to take home. And I think that will be a breath of fresh air.